Welcome to the session on designing a resilient global financial system at the Global Solutions Summit 2022. My name is Akshay Mathur. I'm the director of ORF Mumbai, as well as head of the ORF Geoeconomics program. We're particularly delighted to host this session, which is based on the Task Force on International Finance, which is being organized under the T20 Indonesia, part of the G20 presidency of Indonesia in 2022. As you know, the global financial system has been exposed to several geopolitical and geoeconomic shocks during the last decade. Pandemic, climate change, and military conflicts have prompted policymakers to introduce better risk assessment systems, safety nets, and response mechanisms. These new challenges have exacerbated the challenges many nations are already facing. It is clear that we need a reformed global financial system that is more resilient to shocks, more effective in meeting the needs of the real economy, and more responsive to the technological changes in the global economy. This session seeks to examine how the financial system can be designed to address issues of international financial governance that are likely to remain a priority over the short term, medium term, and the long term. This session will also explore how policymakers at the G20 and G7 and other multilateral institutions and international financial bodies should prioritize the global economic governance agenda to ensure a more effective international coordination and cooperation for steering the global economy. It is a real pleasure and privilege to have panelists here with us today, experts and leaders in their field. I welcome His Excellency Mohammed bin Hadi Al Hussaini, Minister of State for Financial Affairs of UAE. He's also been a banking, finance, real estate, and investment professional before he started his tenure as the minister. I also warmly welcome Mr. Singh, Deputy Secretary General of Iosco. He has held several positions with the Government of India before joining Iosco, including a stint with India's securities regulator, the Securities and Exchange Board of India. Welcome, Mr. Singh. I welcome Richard Samans, Research Director of ILO, and he's also had previously worked with the World Economic Forum, the White House Global Green Growth Institute. And finally, I welcome Mr. Reza Siregar, head of the Indonesia Financial Group. He has had several stints, including with the IMF, the ADB, and of course, also as an academic. My pleasure to invite you all. Thank you for joining us today. What we will do is first take opening remarks from all the panelists, about 5 minutes. And then as we get a chance, I will ask a few follow-up questions and then close with final statements. I would first like to invite His Excellency Mohammed bin Hadi Al Hussaini, the Minister of State for Financial Affairs of the UAE, for his opening remarks. Over to you.
Thank you, Akshay. I'm pleased to be here and take part in this discussion to address global financial resilience. I hope the discussion today addresses the recovery's most critical priorities, especially the scarring effects that are driven by supply chain disruptions, inflationary pressures, poverty, and unemployment as we collectively seek to enable a sustainable and inclusive economic recovery. The roots for the modern pillars of financial resilience dates back to 2008, where the financial crisis made us prepare for adverse effects, including heightened statutory reserves and capital requirements, and supported by strict and more frequent stress testing. This has led to an effective system which enabled our economies to withstand the effects of the pandemic. But this underlines the question we must ask ourselves: what have we learned? The monetary measures were rolled out to provide much needed liquidity for financial institutions, while fiscal measures played a vital role in enabling business continuity. These were effective considering that the level of resilience exhibited during the COVID-19 pandemic demonstrates that at our core exists a strong financial system. We must continue to actively encourage multilateral action as recovery has once again tested the resilience of our financial systems. The G20 agenda set forth by the Indonesian presidency provided a strong indication towards the right components of a resilient global financial system, which the UAE and the G20 countries actively support. In the UAE, the pandemic has asserted critical challenges that required policy action totaling over $93 billion. This has reminded us once again that the financial sector resilience is the key enabler to financial stability and economic growth. As the pandemic transitions to endemic status, the UAE now leads a strong recovery, where we expect our economic growth to exceed the pre-pandemic levels and reach 4.2% by the end of this year. On our end, we will continue to actively prioritize the exchange of lessons learned with our G20 colleagues to better inform global recovery efforts and achieve sustainable, balanced, and inclusive growth. I'll conclude my remark today by stating that the UAE net zero commitment by 2050, in line with the Paris Agreement, the UAE seeks to become a global hub for sustainability, and we would like to work with the G20 and other global forums on integrating global efforts in this area as we prepare to host an impactful COP28 next year. Thank you.
Thank you very much, Your Excellency. May I now request Mr. Singh to give his opening remarks.
Thank you very much, Akshay, and thank you for the invitation. Let me start with a few words about my organization, Iosco, or the International Organization of Securities Commissions. So this is the global standard setting body for securities regulation with over 130 securities regulator members who together regulate more than 95% of the world's capital markets. Our three objectives are investor protection, market integrity and efficiency, and financial stability. Clearly, all these three objectives are important for the topic of the day, which is building a resilient financial system, which itself is built on the foundation of a short but powerful word, which is trust. So our three objectives go to the many dimensions of trust: investor protection, so that the investor can trust his or her intermediary; market integrity, so that market participants can trust that the market is not rigged or unfair; and financial stability, so that the public can trust that the entire financial system will remain stable. At a time that market-based financing makes up for around 50% of global financing of the real economy, the role of trust in these markets has become even more important. So these three objectives of Iosco inform our key priorities that underpin our work on financial system resilience, and I will touch upon three of them: financial stability itself, sustainable finance, and technology. So on financial stability, as was just mentioned by His Excellency, there has been a lot of work that has been carried out by the standard setting bodies and the Financial Stability Board under the umbrella of the G20. The combined efforts over the last 10 to 12 years have resulted in better capitalized banks and more resilient financial institutions. And recently, Iosco has been examining the different financial stability issues that were brought to the fore by the pandemic, but also are relevant in the context of the latest military conflict. So all of these have clearly focused attention on the fact that liquidity is king in financial markets, and that is especially important because of the role of market-based financing. So we have been working on things like money market funds, open-ended funds, short-term funding markets, corporate bond markets, and margin requirements. The underlying debt markets, the bond markets, are crucial because they have grown significantly, but they are quite less liquid compared to other traded markets. And their market structures continue to be largely dealer intermediated, unlike equity markets. And there has been a lot of collaboration with the FSB and the G20 in this regard. Coming now to sustainability. Now, this has been really important for Iosco, given the flood of investment into sustainability-related products in recent years. However, the rapid growth in ESG investment has given rise to an increasingly fragmented regulatory landscape. And for sustainable finance to grow at scale in a resilient manner, it needs proper regulation. To mitigate that problem, you all know that Iosco moved swiftly to support the IFRS Foundation in its efforts to launch the International Sustainability Standards Board focused on enterprise value creation. And we participated at COP26. We'll be very happy to participate at COP27 and COP28, as His Excellency mentioned. And we were happy to see our joint efforts bearing fruit, not only in terms of the announcement of the establishment of the International Sustainability Standards Board, but also the release of the prototype on climate standards, as well as the important announcement regarding the consolidation of some of these other bodies into the IFRS Foundation, like the VRF and the CDSP. Now that the International Sustainability Standards Board is hard at work with the development of the exposure drafts on climate and general requirements, our focus in Iosco is going to be reviewing these standards before making a recommendation to our board as to whether they should endorse these standards. This endorsement can be a game changer if these standards meet Iosco's expectations. It can be a game changer with regard to its adoption all over the world by our 130 members. At the same time, we are committed to ensure that the standard setting is done in public interest, following due process through the work of the monitoring board of the IFRS Foundation that we chair. Very quickly, beyond sustainability reporting, we have also made a lot of progress with regard to the role of asset managers and the transparency that is needed with regard to how they take into account sustainability issues into their investment decisions. And we pointed out the risks of greenwashing and the role of investor education, but also supervisory and enforcement action by regulators. We also published recommendations regarding ESG ratings and data providers. And then we will go on with a huge task in terms of working with our membership towards the implementation of these recommendations. And we are putting together an expansive capacity building program to help our members rise to the challenges. That is a broader point for Iosco, given that emerging markets make up around 75% of our membership. We will continue to work also on things like assurance and the functioning of carbon markets. Before I close, let me mention very quickly a couple of points with regard to fintech and especially with regard to crypto assets. And last week, we published a detailed report setting out how decentralized finance, or DeFi, is quickly evolving to mirror conventional financial markets. We carried out a comprehensive review of the fast evolving market, its new products, but also the key risks for investors and possible conflicts of interest. We are also working on the so-called stable coins and other crypto markets, and we will examine features such as platform providers, distribution chains, and market trends. And we have recently set up a board-level task force in this area. So let me close here, Akshay, with regard to the work that we are doing on financial system resilience. It goes beyond the three that I mentioned: financial stability, sustainable finance, and fintech. But for now, let me leave it here and hand it back to you. Thank you, Akshay.
Assessing your points on financial stability and sustainability and decentralized finance or fintech are very well taken. And clearly, they seem to lend themselves to what the new design elements of a global financial system needs to incorporate. So hopefully I can come back to at least one or two questions on how financial stability can be maintained given what is happening in the world with all kinds of shocks, and how the mandate of the Iosco can help actually help nations and experts and regulatory bodies and financial markets think through how to deal with shocks, macroeconomic shocks, particularly short-term, medium-term, and long-term. But I appreciate it. Thank you very much. May I request Mr. Richard Samans, Research Director of the ILO, to give his opening remarks?
Yes, thanks very much, and good day to everyone. I thought what I would do is to maybe try to complement our colleagues with a bit more of a macro and real economy set of observations and suggestions. But before doing so, let me salute Mr. Singh and Iosco for the great leadership and foresight that they are showing in driving progress on the element he talked about regarding helping to ensure that we have the proper information in financial markets and in company boardrooms to be able to assess some of the longer term risks related to environmental, social, and governance matters. But let me return to this larger macro context that Akshay, you just referenced yourself. I think what I would like to suggest is that when we think about the resilience of the global financial system, we have to be observing currently developments with a rising degree of concern because there are real economy risks building further in several dimensions. One, of course, is the pandemic. It's not over yet. And it is continuing to have a very serious and uneven effect in the real economy, in societies, and in well-being, living standards across the world. We in the ILO, we particularly track the human element of this. And hours work, we are projecting to still be 2% below the level they were in 2019 at the end of this year. And we don't see, with the exception of maybe some of the advanced countries, we don't see a full recovery until 2023 or beyond. That is equivalent to 52 million jobs, full-time equivalent, below 2019 levels at the end of this year, and 207 million unemployed, which is 21 million below the 2019 level. So just when you look at it from a labor market perspective, that's very serious indeed. Then if you look at it from living standards, you've got 30 million people who've been pushed into extreme poverty, according to the World Bank, thus far by the pandemic. So the pandemic is still a very significant real economy shock that's playing out. Secondly, inflation. We are seeing prices rise in various markets. Interest rates are beginning to rise in train. That, of course, has important implications for all borrowers, but not least developing country borrowers who pay in currencies other than their own, and may be borrowing, since they're borrowing in those currencies where interest rates are rising, may be very well affected. The World Bank itself put out an alarming set of observations and analysis earlier this year, suggesting that quite a number of developing countries are facing some significant risks, debt sustainability risks. Third, of course, is the recent war in Europe, and that is raising questions not just about rising prices, but indeed potential scarcity of food and fuel in key markets. And all of the above is tending to drive more, supply chain nearshoring and reshoring, which also has important implications for developing countries. So these are some of the immediate real economy worrying considerations for global financial stability and resilience. And then we've got the one that Mr. Singh had just referred to, which is with regard to climate change, which is more of a ongoing or longer, medium to long term, significant risk to orderly conditions in financial markets and the like. So the point I want to make here is that when we think about the international financial system and building the resilience of it, we have to think not only about some of the prudential architecture and machinery, but also the international community needs to think very seriously about whether it can pull together a strategy to try to support the real economy as it confronts these very considerable headwinds, which do threaten, quite potentially a developing country debt crisis, in the context of decelerating growth in much of the world economy with higher inflation, and the full further context that we've had a dozen years of extraordinary liquidity provision, and we've got balance sheets of central banks and resources of national treasuries that have already been very, very deeply tapped to support real economic activity, coming from the great financial crisis through the pandemic and the like. And so this, I don't need to be unduly downcast in, but I do think, since the topic of the session is resilience, that we need to think about that larger context. Now, I'm here not just to ring an alarm bell. I'm also here to make a suggestion, and perhaps we can get into the details of it a little bit later on. But there is a way, I think, to try to introduce some countervailing force vis-a-vis these real economy risks and shocks to the internet, to the world economy, and particularly in respect of developing countries. And that is that there is quite a considerable amount of unutilized, what I will call colloquially, financial firepower in the international financial institutions that have not yet been tapped fully. And we in the ILO, and I personally put out a working paper in the fall, taking a look at how the international financial architecture, particularly the public international financial institutions, could be, their capital and their skill set and their tools could be more fully and collectively optimized to provide a significant increase in external flows to lower middle income and low income developing countries in the years to come. And I'll just hit a few of the main elements of it, then I'll stop, and perhaps if there is interest in this, I can get into a little bit more specifics. But one is that the MDBs, the multilateral development banks, collectively have about an estimated $750 billion of capital headroom in their balance sheets that could be utilized without affecting their AAA status in the markets. And some of this, I'm suggesting 60% of that, take it, maybe utilize 2/3 of that, and then 60% of that could be used for so-called blended finance under the right frameworks, the right risk mitigation efforts to be able to mobilize a much greater degree of both domestic developing country and international private sector, institutional investor funding of SDG related sustainable infrastructure and industry, which create jobs and improve living standards. And then the third element of it is to make a larger, more concerted and organized attempt to apply the special drawing rights distribution that the IMF very importantly authorized last summer in a way that mobilizes from advanced countries and upper middle income countries the utilization of, say, about half of that for lower middle income and low income countries in some key areas. If we did these three elements of better utilizing for the support for the real economy, particularly in developing countries, of the existing capabilities and capital in the international financial institutions, I estimate that over the next 7 years, an additional $2 trillion in such external flows could be mobilized for these vulnerable countries for the purposes of sustainable development, and which would also have positive externalities for the climate change fight as well, and would create significant amount of additional income and jobs and improved living standards in a way that would create a virtuous circle, and as opposed to what I painted at the very beginning of these remarks, which is the potential for kind of a vicious circle of real economy risks and shocks. I think I'll stop there so as not to go on too long, and back to you, Akshay.
Thank you so much, Richard. I think your point on the pandemic and inflation and war being the greatest considerations, ongoing as well as the new considerations, and the financial firepower, whether it's with the MDBs or SDRs, I think is very well taken. And hopefully I can come back and follow up with a question. Is Reza Sirigar here with us? Okay, I do not see him.
I'm afraid not.
Okay, so let me get into, thank you so much for your opening remarks. Your Excellency, may I start with you? Of course, when we think of design elements for the global economy, the G20 obviously comes to mind. It was formed as a response to an economic crisis, and it remains for most nations, for the world at least, still a body where most of the design work of global economic recovery is happening and can happen. So my question is, how can the G20 ensure financial resilience, inclusive economic growth. So to in a way that caters to both the developing nations as well as the developed economies.
Thank you, Akshay, for the question. And first, I think we should aim to build on the digitization trend that was triggered by the pandemic. We should do so by enabling the financial innovation and digital financial services, while addressing the emerging challenges that come with that from the digital currencies. Then we should approach the physical weaknesses in new ways and through structural policies where needed. The pandemic led to an unprecedented rise in global debt, as my colleagues have also mentioned, which brings debt sustainability to question. Global initiatives and technical assistance programs by international organizations will be important to help jurisdictions in building capacity and to accelerate regulatory reform. Finally, synergy is key to enable the provision of comprehensive solutions that address global priorities. For example, financial resilience objectives should not be viewed in isolation, and questions must be asked on how sustainable finance can be embedded into financial markets and what policies are needed to enable this transition. Thank you, Akshay.
Thank you very much. Mr. Singh, you had mentioned about the main goals of a securities regulator, and you spoke about investor protection, markets, and financial stability. And you gave some forward-looking ideas on what Iosco is doing regarding financial stability, sustainable finance, and decentralized finance. I take your point about liquidity. I think you said in times of distress, particularly, it's the most important. Can you give some design? So as I understand it, if I were to interpret what you were saying, as well as what Richard was saying, obviously the new challenges like digitalization and sustainable finance, we have a greater opportunity to design it right, because those are new challenges and most of it is just architecture is just being put in place. What do we do in the case of systems where we have existing financial systems? We have financial markets, we have banks, you have different kinds of intermediaries, and there are all kinds of macroeconomic shocks that are being felt, whether it's a pandemic or geopolitical events. What are some of the design principles you would say for the existing architecture, the existing financial system, so that they can be reconfigured, upgraded, re-engineered? I don't know. I'll wait for your word for it. But so that we can strengthen resilience in the existing system.
Sure. Thank you, Akshay, and thanks also to the others. I think Rick, your comments, and Your Excellency, your comments, I think they were very, very helpful in terms of trying to get the balance right in the discussion. So it's not just about financial markets. Financial markets essentially mirror what happens in the real economy, and the real economy, the point that was being made with regard to where things are now in terms of inflation, the outlook going forward in terms of possible scarcities. I think all of those are hugely, hugely relevant to what we are doing now. I think it's an interesting question you pose, Akshay. I think it's a little bit difficult to completely segregate conventional, traditional finance from what we were talking about in terms of the forward-looking aspects of it, financial technology, but also sustainable finance. Because I think in their coming together, you get not only risks that, of course, as regulators, we love to look on the risk side of things. That is just in the DNA of regulators, but opportunities, and that's the word you used as well. But I think just to answer your question there, I think the important aspect there is about, and this is what we have been doing, to take a magnifying glass and to look at the different components of the financial system So yes, we have looked at banks, and again, that was the point that was made right in the beginning in the opening address, that banks are far better capitalized, and they have, with the Basel reforms, they are doing much better. And I think that is essentially, that was crucial, when the pandemic struck, because we were sure and we were quite confident that banks are not going to, fall over, because that could be really disastrous for the economy. So that is important, that has happened. It is also important to look at the other aspects of the system and central counterparties that I mentioned, without getting too much technical about these types of things, are an important node in the financial system, because on the one hand, they of course net out the different types of risks. I don't want to get too technical, but on the other hand, they can seem to be almost, at least in the eyes of some, risk concentrators. So while they are supposed to be risk, aggregators and cancelers out, but they can also be seen to be, nodes. And that is where we have been able to, kind of improve their resilience. That is the work that Iosco has done together with other bodies like the Committee on Payments and Market Infrastructures. Now, these are not as much talked about as banks are, for obvious reasons. But then that is the place where, the banks connect. Banks are clearing members to these CCPs, and therefore it is important, A, that banks are capitalized, but B, that the financial resources are in place for these types of central counterparties, so that when there is high volatility, as has been the case now, that the trades themselves are appropriately assured, so that you have enough capital in the system and enough margining in the system. So this is something that has been going on. It is a very important part of financial system resilience. But then it is also important, as I was saying, to look at things that are not banks, and these are areas that come pretty much centrally into what we do. So you think about money market funds or open-ended funds, and people can sometimes make comparison between runs on banks and runs on funds. Well, they are not exactly the same, but that is an important part of the work that we are doing, because that is liquidity risk management. And the good news is that we've had principles and recommendations that we've actually put out a few years ago. And probably an important high-level point, Akshay, is that what the global financial crisis taught us is that it's not enough really to just put out these principles at a global level, but we've got to go out with, essentially with report cards, to actually check what is happening in different countries, and in fact with different institutions. So that is the work which we are, as we speak, doing. So the principles on liquidity risk management are being reviewed by us as we speak, looking at what the asset managers globally have done in the last 3-4 years, but also what regulators have done over the last 3-4 years. So that is an extremely important part of the work we are doing. I think the other part that I think cannot be emphasized enough is that the market structure is important, because what we are really talking about, if you actually step back and look at what the sources of the crisis are, and Rick in his comments kind of was going there in terms of, okay, so we've got a lot of debt in the global economy now. Now that debt itself is usually taken up by institutions that operate on a buy and hold type of a strategy. There is not that type of trading that happens in equity markets or even in futures markets, for instance. But it is important to be able to look at these market structures, these market microstructures, and say, have we done all that we can do? Understanding that debt markets are different, but debt, as we know, is at the root of most crises, and therefore, to that extent, to be able to have enough liquidity in the trading, and enough transparency, I think can actually help. Because when you have greater transparency, then you can reduce contagion risk. Because if I don't know what you are thinking and what you're doing and what you're holding, then I will basically, hold on to what I have. And if everyone just does this, then that is where things freeze up, and that is a crisis. So that's probably an important part there. But then just to make the bridge to the other points that were being made here, I think the aspects about what can be done in emerging markets. And I think you mentioned that, Rick mentioned that, and His Excellency mentioned that. And I should mention that just a couple of years ago, less than a couple of years ago, 2020, after the pandemic, we actually from Iosco produced quite an important report on capital market development in emerging markets. And in fact, I presented it to the G20 in 2020 in that under the Saudi Arabian presidency. So I think that is an important aspect there. If you were to tie it to the discussions that we are having with regard to first sustainability, and then I'll come a little bit to technology, I think that is where you have also an opportunity. Why? Because emerging markets clearly are also markets, well, I don't want to overgeneralize, but if you look at sustainability, then where does most of the pollution come from? If you look at climate, it comes from emerging markets. So emerging markets also need that type of financing. And if you have markets that are, as I say, fair and transparent and with market integrity, if you have those types of markets, that is an opportunity today, then there is, or at least there has been, enough global money seeking returns. And those returns will be available in emerging markets. And especially if you have sustainable finance opportunities, that is where you can get flows into these markets. That is what then builds depth in these markets. And once you build depth in these markets, and with the increasing sophistication of market participants that then try and follow international standards, because international capital flows encourage people to look to international standards. And that is where you actually have a virtuous cycle. I'm also using the virtuous cycle analogy here. And then that is where you can have emerging markets essentially become more resilient to shocks using the opportunity that sustainable finance provides. And then the last point that I would make is with regard to the third element that I had said, which is technology. So not only have we been working with regard to crypto assets, but it is also important for emerging markets because technology can equally be an opportunity there. And in fact, we consulted actually earlier this year on quite an important report for emerging markets on innovation facilitators. How do you set up innovation hubs, regulatory sandboxes, and accelerators? And it's not just a report about saying, well, these are good things and you should just go and do them. We actually provide a decision tree in that report. And that is, if I was an emerging market regulator, then I would expect to look at that report and say, okay, what objectives do I want to achieve? I want to do something with regard to promoting technology, but what type of facilitator should I set up? So if you answer, some questions, you will get to the answer about saying, what type of innovation facilitator should you set up? Should it be a sandbox? Should it be an accelerator? Should it be an innovation hub? And there we have tried to distill the global knowledge that essentially we get because of our members to try and help our emerging market members in terms of saying, okay, this is an opportunity for you as well. So I think with all of these taken together, what you can do is to increase the depth in these markets, in emerging markets, but also globally with regard to fixed income markets, as I was saying, if we are able to carry out reforms, and that is something that we are engaged in, then in that case, you can actually make the financial system more resilient. And in that sense, and I do want to note the point, though, that Rick has made rightly, which is about also being cognizant that this is a different phase to the pandemic phase in terms of the firepower that even central banks have now. In an increasing inflation trajectory, the approach is different. And that's why I will say that central bank interventions were extremely important in 2020, but that is not something that should be taken for granted with regard to how central banks operate, because they have a really important task with regard to monetary policy as well as financial system stability. It is therefore important that without presuming central bank intervention, that the financial system itself self-insure, that the private sector self-insure, and that it can do by developing these institutions that we are regulating for. But it is in the interest of the financial system that they build up the type of liquidity and resilience that is needed to be able to make sure that there is adequate self-insurance without drawing on the state or on the central bank to be able to save the markets. So these are just in the nature of some thoughts with regard to what we can do going forward. Thank you.
No, thank you. And your point, I think, is very well taken, that while there is an existing financial system and we have new challenges and new areas in which we need to design regulations, I think we can do both at the same time by ensuring that what we are fixing accommodates for the new challenges at hand. And it does not have to, I think there's a sense that it has to be done in parallel. In fact, what you're saying is that it has not to be done parallel, but together. And I think that that point is very well taken. I think that report you're talking about, which I apologize, I have not read, but on the decision tree and what can be taken on as a sandbox, I think that could be a good reading for not just regulators, but private enterprises and startups across the board. And so thank you very much, Mr. Singh. Richard, perhaps coming to you for this question, and I think we'll probably only get this chance now before we close. There is so much pressure to make a system resilient. The shocks have any kind of macroeconomic shock. Obviously, there is a tendency for capital to be more to return to safe havens, to safer nations. Is it possible? I think your idea of financial firepower, particularly calling out the MDBs, was because and if I were to interpret your statement properly, that they're the only ones that have the capacity to actually step up and be able to provide that kind of the scale at which you're talking about. And I see that there are independent committees being taken up. I don't know what the latest is and what their findings are. There was initiatives on MDB balance sheet optimization. I don't know what the learnings from there was. I think some of the credit rating agencies have come out and said it's okay, the AAA rating can be maintained and you can still, but I think, I'm not sure. So maybe you can develop on your ideas a little bit more to say, what is restraining the MDBs then to be able to then do exactly the things that you've just suggested, those 2 or 3 things?
I think the leadership of most of them see that they need to have their so-called business model evolve so that they are more catalytic and have an eye on the total mobilization. That's part one. Part two is that, whenever a board gets into a discussion about its capital structure and tries to make decisions about it, it's complicated. And these boards, of course, are composed of governments. And so you need the board to have strategic alignment behind, a more full use of the capital and network in a network fashion. So there has been lacking thus far, in my view, that type of a vision and critical mass of strategic alignment within the boards of these institutions. And in the absence of that, we're sort of path dependent, and they continue to make good incremental progress, but not the type of transformational progress in terms of mobilizing the kinds of funds I'm talking about. Just to put a fine point on it, maybe I'll put the paper in the chat so people can see the details here. But by doing these 3 things of maybe using 2/3 of the available extra capital headroom, using maybe 60% of that in blended finance in a way that helps to crowd in private sector finance, and then wealthier countries donating around half or so of their SDRs to developing countries in some key areas, we could really address some of the most severe real economy risks to financial stability in the world over the next several years. We could fund fully the WHO ACT-A COVAX initiative, which is probably the public use of resources that has the highest conceivable possible multiplier effect. I mean, if you get people healthy or better protected, that is a huge tonic for economic activity. Secondly, this source of funds could also remove or at least make huge progress in reducing one of the most severe climate-related risk, which is coal-fired power plant generation. There is a need for an accelerated, coordinated effort to intervene in energy markets to promote the early retirement and replacement, particularly in developing countries, and notably including India, of coal-fired power generation. It's not going to happen on its own at the pace that's required by the Paris Agreement. But the resources are available in the system between the capacity that the MDBs have on the one hand and these SDRs on the other. But just to roll the whole thing up, this would enable the mobilization of about an average of 4% of GDP in additional external flows to lower middle income and low income developing countries. And that's 82 countries over the next 7 years, not just for 1 year, but over the next 7 years. That is equal to or slightly more than the level of effort, the level of incremental flows in the Marshall Plan to Europe after World War II. And as I say, this could be accomplished without asking any national legislature for additional foreign aid, traditional bilateral ODA appropriations. These are resources that have been approved and are sitting in the system, in the international financial architecture now. And at a time when, even before the crisis, UNICEF estimated that 25 countries were spending more on their external debt service than they were spending on social protection, health, and education. That, no doubt, that calculation has gone up in the last 6 to 9 months. And it's poised to get worse. And while the G20 has done some good work in debt sustainability suspension initiative, which is now expired, and is working on this common framework to help to promote debt restructuring, it's going very slow relative to the dynamics in the real economy that we've been discussing here. So there's a need, but even more importantly, there's a capacity to be able to make huge progress on essentially agendas that have been universally agreed. That's the WHO's ACT-A and COVAX initiative, the SDGs, which are universally subscribed to, that we just don't have they're not self-executing. They need significant additional both domestic resource mobilization and international financial mobilization. And if we did this package right, as I discussed in this working paper, you would be able to use the external mobilization of finance in a way that helps to incentivize domestic resource mobilization, which, by the way, was the approach taken by the Marshall Plan that most people, may not be aware of. So I think that the opportunity is there, but it will take, to your prompting question, it will take some concerted and collective leadership. No single country can affect these changes because it's a matter for the boards of each of these institutions, the MDBs and the IMF, to take. But that would enable us to triple ODA, the levels of ODA or external ODA related financing to these countries, these 82 countries over the next 7 years, which I think is a huge opportunity, not only at a human level, but also for the financial system too. It's an insurance policy. It's sort of a macro insurance policy to complement the prudential ones that Mr. Singh quite rightly was talking about are equally important.
Well, that brings us to the end of the session. I think part of our attempt to do these sessions is so that we can share and evangelize some of these good ideas, and with experts such as yourself. Only thing that's left for me to do is thank you for being with us today. Your Excellency Mohammed bin Hadi Al Hussaini, Minister of State for Finance of the UAE, Mr. Tajinder Singh, Deputy Secretary General Iosco, and Mr. Richard Samans, Research Director ILO. Thank you very much for being with us. We have only time for this much today, but hope you will continue to engage with the Global Solutions Summit, which is underway. Thank you and goodbye.
Thank you.
Thank you.